Hello, everyone. Good morning, and welcome back to our channel. Today we're going to be discussing a topic that's been making headlines in the financial world. Europe's Stoxx 600 falling amidst rising US-China trade tensions. To understand what this means, let's start with who or what is behind these trends. The Stoxx 600 is a stock market index that represents the performance of 600 large and mid-sized companies listed on European stock exchanges. It's considered one of the most reliable measures of the European economy's overall health. So when we say it's falling, we're talking about a significant decline in the value of these stocks over time. But why should you care about this? Well, for starters, Europe is home to some of the world's largest economies and companies, including Germany, France, and the UK. A downturn in their stock market can have far-reaching implications not just for European businesses, but also for investors around the world who hold stakes in these companies. Moreover, trade tensions between the US and China are having a ripple effect on global markets. The ongoing dispute over tariffs, intellectual property rights, and other issues is causing uncertainty among multinational corporations with operations in both countries. As this situation continues to unfold, it's likely that European businesses will be affected indirectly or directly, which could lead to more instability for investors. In the next section of our video, we'll delve deeper into what's driving these trade tensions and how they're impacting Europe's Stoxx 600. We'll also explore some potential implications for global markets and economies as a whole. So let's take a closer look at why US-China trade tensions are a story worth paying attention to. The roots of the US-China trade tension can be traced back to the early years of their economic relationship, which dates back to the 1980s when China began to open up its economy to foreign investment. At that time, the U.S. saw an opportunity to expand its market share in Asia and establish itself as a major player in global commerce. As China's economic growth accelerated in the late 1990s and early 2000s, it became increasingly dependent on imports of technology and intellectual property from the U.S. This led to concerns among American companies that their proprietary knowledge was being stolen or copied by Chinese firms without permission or compensation. In response, the U.S. government began to implement trade restrictions and tariffs on imported goods from China, with the aim of protecting its domestic industries and safeguarding national security interests. However, these measures were met with resistance from China, which argued that they constituted unfair trade practices and targeted discrimination against its economy. Over time, tensions between Washington and Beijing escalated into a full-blown trade war in 2018, when President Trump imposed tariffs on $365 billion worth of Chinese goods. China retaliated by imposing its own tariffs on U.S. exports, sparking a vicious cycle of retaliation that has continued to this day. As the trade tensions between the U.S. and China intensified, the global economy began to feel the reverberations of this escalating conflict. The European Stoxx 50 index, which tracks the performance of leading European stocks, started to decline in tandem with the rising uncertainty in international trade relations. Investors became increasingly wary about investing in companies that relied heavily on Chinese exports or had significant exposure to the U.S. market. In a move to mitigate these risks, many multinational corporations began to shift their focus towards emerging markets such as India and Southeast Asia. These regions offered more favorable business environments with fewer regulatory hurdles and lower labor costs, making them attractive alternatives for companies seeking to expand their global footprint. The European Stoxx 50 index reflected this trend, as the share prices of companies like Siemens, Volkswagen, and Deutsche Bank began to decline in response to growing concerns about the sustainability of traditional trade relationships. Meanwhile, policymakers in Europe were struggling to come to terms with the implications of a rapidly shifting global economic landscape. As the US-China trade tensions continued to escalate, there was an increasing sense among European leaders that their continent's own economic interests and values could no longer be ignored. A new narrative began to emerge, one that emphasized the need for greater autonomy and self-sufficiency in Europe's economic affairs, free from the dominance of American or Chinese influence. This sentiment gained traction as some prominent politicians started calling for a more coordinated European response to the challenges posed by the US-China trade tensions. The notion of creating a more cohesive and integrated European economy began to gain momentum, with many seeing this as an opportunity to redefine Europe's role on the global stage. As policymakers in Europe continued to weigh their options, a major breakthrough emerged when Germany announced plans to invest heavily in renewable energy sources, marking a significant shift away from traditional fossil fuels. This move was seen as a bold statement of intent by European leaders who wanted to reduce their dependence on imported oil and gas, which were increasingly becoming a casualty of the U.S.-China trade tensions. The German government's commitment to renewable energy was met with widespread support across Europe, with many countries following suit in an effort to demonstrate their own economic resilience. The impact of this development was immediate, as European stock markets began to show signs of life, with shares in companies like Enel and E.ON surging on the news. The renewed focus on sustainable energy also sparked a new wave of investment in Europe's infrastructure sector, with many multinational corporations seeing opportunities in the region's booming renewable energy market. The success of this initiative was further boosted by the European Commission's announcement that it would be launching a major review of its regulatory framework to support the development of a more integrated and sustainable economy. Meanwhile, the U.S.-China trade tensions continued to escalate, with both superpowers imposing increasingly harsh sanctions on each other. Despite these challenges, European leaders remained resolute in their determination to forge ahead with their own economic agenda, one that would prioritize sustainability, self-sufficiency, and innovation over traditional trade relationships. The stakes were high, but the sense of momentum was palpable as Europe's policymakers took a major step towards creating a more autonomous and integrated economy. As the days turned into weeks, the challenges facing European leaders only intensified. The U.S.-China trade tensions had become increasingly complex, with both sides imposing new sanctions and retaliating against each other's moves. This created a perfect storm of market volatility, as investors struggled to navigate the shifting landscape. The public attention was intense, with many wondering if Europe would be able to weather the storm. Analysts were quick to point out that the European economy was heavily reliant on exports to Asia, and that any further escalation of tensions could have devastating consequences for growth. However, not everyone shared this view. Some saw an opportunity in the crisis, arguing that Europe's focus on sustainability and self-sufficiency would ultimately prove more resilient than traditional trade relationships. On a personal level, European leaders were under immense pressure to deliver. The fate of their country's economies rested squarely on their shoulders, and the weight was beginning to show. Chancellor Merkel was particularly vocal in her criticism of U.S. President Trump's policies, while French President Macron took a more conciliatory approach, seeking to find common ground with his American counterpart. One turning point came when the European Council agreed to increase its defense spending by €5 billion over the next decade. This move sent shockwaves through Washington, as it was seen as a challenge to U.S. dominance in Europe and beyond. The implications were profound, as it marked a major shift in the balance of power between old allies. Despite this development, there remained many who doubted that Europe could truly succeed on its own terms. Critics argued that the continent's economy was too small and too fragmented to compete with the behemoths of Asia and the U.S. However, European leaders were undeterred, convinced that their path forward would ultimately prove more sustainable in the long run. As they pressed on, it seemed increasingly clear that this moment marked a turning point in history, one that would determine whether Europe emerged stronger or weaker from the maelstrom of global uncertainty. As we reflect on the current state of U.S.-China trade tensions and their impact on Europe's stocks index, it becomes clear that this is more than just an economic issue. It represents a clash of ideologies, a struggle for dominance in the 21st century world order. For decades, European leaders have been navigating the complex web of relationships with old allies like the U.S. and new partners like China. They've walked a tightrope between loyalty to their historical ties and the need to forge new paths forward. Throughout history, Europe's economic might has played a significant role in shaping global events. From the Industrial Revolution to the European Union's creation, the continent's growth and prosperity have had far-reaching consequences for the world at large. Today, as we witness this great shift, It's worth remembering that Europe's resilience is rooted not just in its economy, but also in its culture and values. This moment represents a critical juncture in human history, an opportunity to redefine what it means to be global players. We're seeing European leaders take bold steps towards self-reliance while maintaining strong ties with other nations. This new trajectory holds immense promise, as it allows Europe to shape the rules of globalization and create its own destiny. So what can we learn from this unfolding drama? First and foremost, that even in uncertain times, there's always hope for change. European leaders have long demonstrated a capacity to adapt and evolve, often against all odds. Their determination is inspiring, particularly when contrasted with some of the more isolationist tendencies coming out of Washington. Looking ahead, as we look at what this might mean for our own lives, whether that be on an individual level or in terms of how it affects global markets, one thing becomes clear: Europe's future matters. The world is changing rapidly and irreversibly. Whether you're a long-time observer or just starting to grasp the intricacies, understanding these shifts can have profound implications for your own choices. Ultimately, this moment reminds us that we all share responsibility in shaping our shared destiny, whether as leaders on an individual scale or as global citizens who care deeply about what happens next. As Europe embarks on its new journey, it's essential to recognize the significance of their efforts and be inspired by the resilience and vision of those leading them forward. As this pivotal chapter unfolds for European nations, a key takeaway is clear: leadership matters more than ever before, in both local communities and worldwide contexts alike. Thank you. Goodbye.